Let's keep this short and real. You hear it all the time. Manufactured homes can come with higher interest rates, and a lot of people, understandably, want to know why. The simple answer is risk, but that doesn't really tell you the whole story. Tonight, we're going to get you the facts. No hype, no BS. Just a clear explanation of what's really going on behind the scenes when you apply for one of these loans. It's important to know that not all manufactured home loans are created equal. Some have rates that look a lot like traditional home loans. The key is understanding what makes them different. So, let's start with the basics. The word chattel is just a formal term for personal property. Think of it like this. A chattel loan treats the home itself as a movable asset. It's financed more like a car, a boat, an RV than a traditional house. The lender secures the loan by holding the title to the home. Crucially, they do not have a claim on the land it sits on. This distinction is everything. It fundamentally changes how a lender views the loan, how they calculate their risk, and ultimately, how much interest they charge you for the money. When the home is legally considered personal property, it means it can, in theory, be moved. Even if it never leaves its spot, the fact that it could be moved puts it in a different category from a site-built home. This legal classification has massive ripple effects. It influences everything from the loan application process to the terms you'll be offered. It's the primary reason why you might see a higher number on your interest rate quote. We're going to break down exactly what this means for the lender, and more importantly, what it means for you as a potential homebuyer trying to make a smart financial decision. It's easy to get frustrated when you see higher rates. You might think it's a reflection on you or your credit, but most of the time, it's not personal. It's a business calculation based on decades of data. Lenders are in the business of managing risk, and a loan for a piece of personal property, even one as large as a home, presents a unique set of challenges compared to a loan that's anchored to a piece of land. Let's set the record straight. Not all manufactured homes depreciate. Pre-1976 mobile homes often depreciate, built to different standards, sold into different markets and usually treated as personal property. Think vintage coaches, lighter construction, and fewer financing options. Post-1976 HUD code homes can hold or even gain value. Depends on location, condition, demand, and community rules. So why are chattel rates usually higher? The big reason is liquidation risk. How fast a lender can resell the home for close to what's owed. If a borrower defaults, it's harder to sell the home quickly for full value. Time on market goes up, proceeds go down. There are fewer lenders willing to finance buyers. The buyer pool is more specialized than for houses in established neighborhoods. Smaller, pickier market equals slower resale and more price pressure. Secondary risks still matter. Park office coordination and lease rules, paperwork and permits. Sometimes, you must move the home. Moving a double wide isn't cheap or easy. Transport, setup. Bottom line, it's resale and liquidity risk. Quick clarification, term length is not why chattel rates are higher. Many chattel loans go up to around 25 years. The pricing premium comes from market reality. Resale is harder if a default happens. Fewer lenders will finance buyers, and the home appeals to a more specialized buyer pool. That combination increases the lender's liquidity risk. Want to push your rate down? Bring a larger down payment. Choose a newer HUD code home from a reputable manufacturer. Prioritize desirable locations and communities with strong demand. Keep your DTI tight and document income stability. Maintain the home, records help, and when possible, structure title and placement in ways lenders prefer. More on that next. We break down the details in the next chapter. Now, here's a critical piece of information that can save you a lot of money. Not all manufactured homes have to be financed with a chattel loan. If you own the land and if the home is permanently affixed to a qualifying foundation, you may be able to retitle it as real property. Once it's classified as real property, it becomes a whole new ballgame. You may become eligible for the same loans as site-built homes, FHA, VA, conventional mortgages. Those loans usually have lower interest rates and longer terms. This is a fork in the road for many buyers. If you can take the real property route, you'll likely get a more favorable loan. It takes extra steps. You'll need a permanent foundation. You'll need the right legal paperwork. You'll need to combine the home and land titles. But the long-term savings can be substantial. A lower rate over 30 years can save you tens of thousands of dollars. It's worth investigating if you own your land. But let's be clear, a chattel loan isn't a bad thing. For many people, especially those in a community, it's the only option. Or for those placing a home on family land, chattel loans are a vital tool for millions. Go into it with your eyes open. Understand the higher rate isn't a penalty. It's not about you personally. It's a business response to statistical risk on personal property. Lenders aren't punishing you. They're protecting their investment. Finding the right loan is about matching product to your situation. It depends on the home. It depends on the land. It depends on your financial goals. If you must use a chattel loan, don't take the first offer. Shop around.